Good morning, everyone. And very warm welcome to the ODI's webinar today. This is the third and final series of 3 webinars that we have been partnering on with CDC Group. And we're delighted to have such a large audience with us today and to meet our fantastic panelists, who I'll introduce in just one moment. My name is Judith Tyson. I'm a Senior Research Fellow here at the ODI, and I specialise in financial sector development and mobilisation of private finance in sub-Saharan Africa. We'll be discussing that, but also today with a focus on development financial institutions as well, who a number of our panelists represent. In terms of housekeeping, we'd really encourage you to send questions, and we're going to have a Q&A at the end. You can use the chat box to send them to me, and then we'll share them out amongst the panelists. I'm sure everyone's familiar with that today. We can also use the hashtag, Innovative Finance, to tweet any questions or comments about the event, and our team at the ODI will forward those on. Let me introduce our panelists. We're very thrilled and delighted to have with us today Vera Songwe, who's the Executive Secretary of the Economic Commission for Africa, and I'm sure it's familiar as one of the leading executives in the discussion on the COVID response. We're also very pleased to have Nick O'Donoghue, who's Chief Executive of CDC, also formerly of the Gates Foundation, and of course CDC is probably one of the most innovative and interesting DFIs on the scene today. We have Søren Peter Andersen, who's General Manager of EDFI. That's European EDFI, which is an industry group representing the interests and concerns of European DFIs collectively. And last but not least, we have Chris Egerton-Warburton, who's a co-CEO and founding partner of Lion's Head Global Partners, who are a global private fund based in Nairobi and very much involved with capital markets in the region. Vera, maybe we can start with you. I just mentioned that you've been very much at the forefront of the discussions, both internationally and within the region, about the response to the pandemic over the last 9 months. I was wondering if you could give us a little bit of a view of how you see the good points and the bad points in the response from the various parties to date.
Oh, thank you, Judith. Let me say good afternoon to everybody. With the system, it's very difficult to know what times it is everywhere. Good morning to those who are on the other side of the world. Listen, good question. I think let me start with the response of the African countries themselves. African countries, I think, for the first time came out in front of the response to this pandemic. Altogether, African countries have pulled together about $46 billion of their own budgets to respond to this pandemic. A large chunk of that $46 billion is $26 billion from South Africa, of course, $6 billion from Egypt. These are countries that have been particularly hard hit from the crisis. And so there has been, and then you have, smaller countries like Benin and Togo that decided to give tax holidays to the private sector businesses so that they could use some of those resources to respond to the crisis. You have Ghana that has taken charge of all the healthcare workers' insurance. So there has been, I would say, a lot of a sort of fiscal response in particular by many African countries. Of course, there's been a doubling of some of the social safety net programs. Unfortunately, because a lot of our economy is informal, it has been very difficult for countries to be able to target, those who need some of the help the most. On the international side, the response has mostly come from the IMF. I must congratulate the IMF immediately after the crisis. They, for the 19 poorest low-income countries on the continent, they wrote off the debt to the tune of about something $228 million. Those countries were able to immediately use those resources again to respond to the crisis. I think so far we have had about, from the PRGT disbursements, which is the IMF fast disbursing facility, over $20 billion of resources have been disbursed. And I think the IMF has really done a fantastic job in terms of working both with some middle income countries. I name again South Africa, Egypt, Morocco, that have had access to the IMF facilities. The G20, on the other hand, worked on the debt service suspension initiative, which is an initiative which is actually born out of African finance ministers asking for a stay on interest payments to both bilateral, multilateral, and private sector debt. We were able to get the bilateral part going. To date, it has delivered somewhere in the order of $4.9 billion of relief to the continent. There is a second round of that that's happening, which goes until June 2021. We're hoping that it goes until December 2021. So that's the big extension. But I think the big thing that we've all been asking for is the special drawing rights and additional release. Africa is asking for $100 billion every year for the next 3 years to actually, respond to this crisis in a solid and systematic way. And the special drawing rights will provide the kind of relief that is needed. Remember that it's not just that, this is the biggest crisis we've had in a century, but more importantly, there is depreciation happening across the countries. We're now talking about the vaccine. How do countries get access to the vaccine if they don't have sufficient foreign currency? And that's why for us, the SDRs become a very important part of that conversation, not just getting the vaccines, but also continuing to get some working capital as Africa launches the African Continental Free Trade Area Agreement. We are hoping to use that to revive our economies, but we need that. And finally, of course, there is the conversation around what we do with the private sector and how we crowd the private sector in. The Economic Commission for Africa, working with many of us on this call and in other places, is working on a liquidity and sustainability facility, which will help reduce the cost of market capital so that more countries have access. We've just seen Ivory Coast go to the markets. We're hoping that more African countries can regain access to markets, but probably and hopefully at cheaper rates.
Thank you very much. So we've seen reasonable responses, a few places maybe where we could have seen more, but overall pretty good. But you'd certainly like to see more SDRs and a sort of longer term financing over the next 3 years as well. Could I take you back to the issue about the fiscal response? I mean, obviously, an implication of that is the level of indebtedness that national governments are incurring in terms of financing that fiscal response, and the vast majority of the funding, I understand, is on debt rather than on a grant basis. I was wondering if you could comment on what you feel about the debt sustainability situation of some of the countries across the region, and I think what we might be fair to say is sort of intransigence in terms of private investors on debt forgiveness.
Three things. I think before we got into the crisis, we had about 5 countries that were already in a debt distress environment. Of the 5 countries, you have Eritrea, South Sudan, Zimbabwe, that are really sort of outliers because their problem is long-standing and it's a question of arrears. Then you had Gabon and I think Mozambique. Then in the category of countries that were in high risk of debt distress, we had a number of about 12 countries in that category, which included, of course, Angola, Cape Verde, Zambia, and a few others. I think what we are seeing is, I think the big question actually on a conversation on debt is really in those 12 countries, is how is that split going to happen? 3 things are going to determine those splits. One of them is if they have much more of that debt as Eurobond, very expensive debt, or other private sector debt. Of course, there is debt from non-Paris Club and non-concessional lenders, which you have raised, which becomes an important issue. We need to look at that and see, what is done around that conversation. There are, as I said, 12 countries in that category. Africa has 54 countries. So if you add 12 plus 5, that's about 17 countries, 5 in already debt distress and 12 in high risk of debt distress. There is a huge number of countries that are still, and this is where the Cote d'Ivoires of the world fall in, this is where the Egypts of the world fall, that had good macroeconomic fundamentals before the crisis. And what we are trying to do and what we're working with them and doing is to say, how can we provide them with the liquidity that they need so that this crisis doesn't take them back much further. This is a one in a lifetime occurrence. It's an occurrence that was not caused by these countries. And so I think as we have the conversation around debt and the debt sustainability, we do need to then make sure that we are not putting all the countries together in one basket. Now, I must welcome the G20 Common Framework for Debt Resolution, because what it does is it begins to provide us with some clarity about what needs to be done. Of course, we have the Zambia case, as you mentioned rightly, where there has been a sort of uncoordinated, unruly attempt to see how you begin to bring the Chinese and the private sector and the concessional lenders together to have a conversation. This is not the way to go. We have some good examples as a la Ecuador. We are seeing now what the IMF is doing with Angola. I think that hopefully the new common framework begins to provide more visibility, more clarity for countries, those 12 countries, and amongst them, which ones want to then address the issue. When you get there, you're in a solvency question, and the question then becomes, what do you need to do? How do you need to restructure? Who do you bring around the table? And I think the international community is seized with the idea that we do need a framework to do that in an orderly, in a coordinated manner. But I also want to continue to stress that this is not the burden of all African countries. There are still some good performing African countries that need to continue to access liquidity so that they can continue to grow. And those ones, I think we need not put together in the sort of overall debt conversation and the debt basket as we're talking. And if you look at the debt conversation, sometimes there is an unfair sort of, conversation around the debt of the African countries. I mean, the European countries have never had the levels of debt they have today, amazing amounts of debt that they have, but they're backed by, the EU and a strong hard currency. And so interest rates are quite low and they continue to go to the market. This does not mean that, Italy, Spain, Portugal don't need, robust macroeconomic programs. And I think this is the question is what new programs, what kind of fiscal stimulus programs do we need, first of all, to get these countries to grow out of the crisis, and then, to get into a stage where we begin to see long-term recovery.
Yeah, I personally thought it was quite optimistic that we saw, the new issuance from the Ivory Coast, because, we're seeing that sort of return to the market. And as you point out, a more nuanced view about the countries that are strong and have, pretty good prospects, as opposed to some of those that have debt sustainability issues that need to be addressed. Maybe I could ask you a slightly different question. You mentioned, the difficulty of providing support for the informal sector, and particularly for the poorest in the region. And there's been, I think, quite a lot of concern about the ability of sort of macro level policies to reach them. We've got a question too, talking about the needs for job support. I was wondering if you comment about, on a more medium-term view, what sort of policy responses you would like to see to support and continue long-term growth, but also to make that more inclusive in terms of the informal sector and employment creation.
I think three things that at least we are trying to do at the Economic Commission for Africa. The first one is to look at, how do we finally begin to target this vulnerable informal sectors of the economy and bring them in. We have partnered with 7 of the largest telco companies on the continent now to be able to see whether we can identify, and so we have about 710 million cell phone numbers to whom we can send messages to different people just to get a sense of, do you have a job? Don't you still have a job? Do you need support? And we're hoping that we can bring these people into some kind of a database where then by country we can begin to assist them. So that's the first thing we're doing. We launched the program. We now have 36 countries on the continent that have agreed and have signed up to the program. It's actually already started working in Congo. I think today it will start in Ghana, and by the end of the year we should have 7 countries already. And the idea here is to say, you have a wife who was probably a seamstress in the market and a husband who was a taxi driver, most of them earning a sort of sufficiently decent income to send their kids to school and, have a decent living, but none of them registered into any formal systems in the country. With COVID, markets are closed, nobody's taking taxes anymore. These 2 people have fallen into poverty, but we don't know where they are. And I think the African Commission's communications information platform, ACIP is what we call it, is the idea is to say, if we go into each country and we can send messages to people like this and they can tell us, we exist. We used to have a good job before, or a sufficient decent job, but now we need assistance. We will start building databases for these people. And so that's the first question, is bringing them into some kind of a formal system. Your second question, what do we do? I think we now have the African Continental Free Trade Area Agreement. For that African Continental Free Trade Area Agreement to work and work effectively, one of the things we're going to need is logistics, transportation, ensuring that we can improve our road networks, our train networks, energy investment. So there's a huge amount, I think, of labor-intensive investments that we can begin to look at. Of course, agriculture and the whole possibilities there. One of the big issues and one of the frights of the crisis is inflation. And we need to look at those sectors where, prices are going up. One of them on the continent, we just launched something called the Africa Price Watch, is food prices. And so if we can double, triple, land, we're doing that in Guinea, in Senegal, that is being put under production and employ people in those areas, it will be particularly important. And finally, of course, is the ICT sector. We just finished last week a 2-week training of 3,000 young girls in coding. Amazing innovations, amazing things. They are all coding, becoming their own, hoping that they can become their own heads of business. And they are now looking at CDC. We will come to you for some funding. But I think that, we had the first 5 innovations from this program, 2-week coding program, just amazing, using the Internet of Things, using artificial intelligence to see how you can solve society's problems that they're facing themselves or their families are facing. And I think that's the other exit, is to see how we can leverage better technology to ensure that we can create more jobs. So it's first of all identifying the vulnerable, then looking at the whole logistics, infrastructure, energy, roads, transport, where we can really create a lot of jobs, and then looking at ICT training, building, and creating those skills for new markets and new jobs.
Yeah, thank you. I think certainly the level of innovation we're seeing around the digital economy in the region is exceptional. I know it's been accelerated, of course, as it has elsewhere, but it's a really great news story for right across Africa. Vera, I know that you need to leave because you've got other responsibilities. I wonder if you'd just like to make any final remarks or any other comments.
I'd listen. I mean, I have another 15 minutes, so maybe I'll just listen and then come in before I leave. Thank you.
Okay, great. Maybe we can switch to Nick then. Nick, thank you very much for joining us. Obviously, CDC is one of the leading DFIs globally, and particularly it has a mandate that focuses exclusively on low-income countries. And I think it would be fair to say too, CDC has led a lot of innovation, particularly through some of its catalyst funds. About investing in those sectors. I was wondering if you could give us a sort of your take on the landscape post-COVID, particularly about whether the prospects are significantly damaged for your investments, but also for private finance in LICs, and what's CDC's take on it. Oh, Nick, I think you're on mute. This is the it's going to be a catchphrase of the pandemic on the webinar, isn't it? You're on mute.
Can you hear me now? I think my headset was not working. Sorry. So thank you. Thanks, Judith. Good morning, everybody. So yeah, look, I think the first thing to remember when you think about COVID and you think about its effect on fragile economies is that every crisis is the same from a financial perspective. And when you think about commercial investors, what happens is people immediately take risk off. They immediately move away from those countries that are furthest away, that they perceive as most risky. And I think that's why development finance, so you get this great outflow of money from those countries. And I think that's why development finance institutions are so important, because we have the opportunity to be counter-cyclical. We have an opportunity to fill that gap, particularly in terms of liquidity for sort of day-to-day business. And so I think, if you look at what's happened in COVID, the DFIs have done a reasonably good job of filling that gap. And of course, it's also important to remember that even before COVID happened, we had the amount of capital flowing into particularly Africa, and Africa, the continent that has the greatest distance to travel in terms of achieving the SDGs. But the capital that was flowing into Africa was well below what was needed if we're to successfully meet those sustainable development goals. So we had an issue before COVID, and obviously COVID has magnified that issue. We've had a lot of time and effort and commitment made to the area of blended finance, and I think blended finance has made a difference, and we've seen some very creative uses of sort of concessionary tools together with more commercial capital in a very sort of innovative way, particularly in areas like climate and SME financing. But even with blended finance, and if you look at the recent data from Convergence, we're seeing 50 to 60 deals a year. We're seeing $10 to $15 billion in volume. We're seeing only 40% of that actually coming from commercial investors and impact investors, as opposed to the DFIs themselves. So we're certainly not seeing a sort of a billions to trillions. We're seeing billions staying at billions. So I think it's unrealistic to think that blended finance will be a solution. So the solution needs to have three components to it. It needs to have speed, it needs to have scale, it needs to have simplicity. And so that's what we've been trying to do at CDC, focus on preserving the work we've done already, because of obviously we have interest in investments in 1,200 companies. We want to see them survive. Strengthen particularly financial systems, particularly by providing liquidity, and then help to rebuild as we come out of COVID. And you can do that in quite simple ways through areas like trade finance, which has been a big part of the response from organizations like CDC and IFC. And then over time, then you can become more. You can look at more complex and more blended, more solutions that like blended finance.
Yeah, thanks, Nick. I mean, I think it's interesting you mentioned about blended finance. I mean, of course, there has certainly been some successes, but the aspiration from the billions to trillions is a long way off, I think, across all institutions globally. And of course, we're also entering an environment where the international aid flows may not be as great, or certainly are not going to be growing. Could you expand a little bit on your comments there about the domestic financial sector? Of course, as you mentioned, there's been a lot of liquidity support to address the immediate crisis. But in the long term, other things that DFIs can do to develop faster, more deeper financial systems domestically?
Yes, I think, look, it's absolutely critical that in the long term we have robust domestic capital markets, particularly in Africa. And I think there is more that organizations like CDC and the other development finance institutions can do. Some of it, I think, is about sort of helping to build a sort of intermediary layer. And so so the work that the organization like the IFC is doing in upstreaming, the work that FSDA is doing in terms of helping to develop markets, I think that's important. Helping, as I say, to fund intermediaries. To some extent, the traditional banks and PE funds that many of us have funded in the past have not provided the answers successfully provided large amounts of capital in these countries. So we also have to be much more innovative, and I think Vera very correctly talked about the importance of technology and IT and more innovative fintech solutions that can sort of disintermediate traditional sources of finance. I think these are really, if we're going to really, I don't think that the local domestic capital markets in Africa are going to be built in exactly the same way as they're built in developed markets, particularly in a world that we live in now, where we've got so much opportunity to exploit new technologies and new ways of doing things and innovate to do things better. And so I think it's a critical function of development finance institutions to take a risk, to invest in those new solutions and innovation solutions.
So you see an opportunity for sort of much more granular, quote, capital markets rather than the sort of critical mass capital markets we've seen, say, in Asia, developing Asia and some of the advanced economies. Yeah, it's interesting. Yeah, I think there's certainly. I was very surprised in Kenya personally when they issued some government bonds on the mobile phones, and I thought, well, that the amount of money that would be mobilised through that is going to be trivial. But actually, it was a huge success. It was very surprising that people on the street actually put in relatively small amounts, and collectively it was quite significant.
Yeah, look, I think that is exactly right. Those are the solutions that are going to make a difference in the future, and they're not the same as the ones we've seen in developed countries or even the more recently developing countries. They're enabled by technology that's developed in the last 5 years.
Are there other areas of innovation that you think will be important for the future? I mean, outside of fintech?
Well, look, I think from a private sector perspective, what the sort of technology revolution is doing is it's enabling entrepreneurs to build sustainable businesses with a whole new customer base, because it's cheaper to access and cheaper to run those businesses. So across the board, and again, I think Vera made this point, across the board, technology presents the opportunity to really make a significantly change the development sort of glide path in Africa, and we've got to be supporting it and investing in it.
Yeah, I think certainly there's quite a lot of research that also shows it relates back to the problem that we were discussing with Vera about how to reach the bottom of the pyramid because of the very widespread uptake of mobile technology, including in some of the poorest households. So there's a lot of prospects there. Nick, I've got quite a few questions coming through from the panel as well. Let me ask you one. One of the questions I have, I sort of summarise this, is about what are the barriers and unfavourable levers, I think, remain in place. What are the big blockers? I guess really what they're asking here is there major things that could be done in the policy environment, either by DFIs or IFIs, that could create a step up in terms of the response, particularly around supporting long-term economic growth in the region?
Well, look, I think I think first we've got to recognize that biggest challenge to investing in Africa, in many countries in Africa, is it lies sort of domestically. It's not just the lack of a domestic capital market, but it's making sure that we've got responsible macroeconomic policies, we've got stable fiscal policy, we've got reasonable interest rates, we've got stable currencies. We've got governments that are proactively supporting the private sector and see the private sector as an important route to growth in those countries. I don't think that exists everywhere. It certainly exists in more countries than it has in the past. And I think one of the really encouraging things is you can look at certain countries now and you can see sort of role models for private sector-led growth. And so I think that's very important. And I think our role as DFI is to support those countries. I think we do have an obligation to our shareholders to preserve and ideally earn a return on our capital. So we've got to be conscious of that. We can't ignore that. But as I said, I think increasingly we have more and more examples in Africa of countries that are pursuing a private sector-led route to growth, and our job is to support that through capital.
Yes, I'd say I'd agree with that. There's, particularly in the last decade, we've seen quite significant differentiation. Those countries who have achieved, macroeconomic and political stability and sound basic environments have really seen their growth take off, and they have been also less affected in this current environment as well. So, yeah, absolutely, those fundamentals are always essential. So maybe I could turn to you. You heard some of Nick's comments about his views from CDC's platform. Of course, you represent the European DFIs collectively in your organisation. I was wondering if you'd like to comment. Maybe we could pick up on the issue about how to support longer term growth or recovery in the region, both in terms of sort of opportunities but also risks.
Yes, absolutely. I mean, I of course, it's evident as Nick explained that the job of DFIs during the immediate response has been to stay put and be present to lead other investors back into the continent during the recovery. And I also very much agree on the points about DFIs need to see where they can help speed up economic transformation that will follow in the recovery. And I'm not sure we are always, as DFIs and donor agencies, working with the governments in a sufficiently strategic way, not just at the macro level, but also at the micro level of getting policy reforms right to help speed up this economic transformations that DFIs are willing to help finance. And I think just a couple of good examples. I think the inclusive financial services is absolutely a critical area, like Nick explained, with a lot of technological development and a lot of potential to unlock private institutional finance. And it's also a very complicated sector to regulate and get equitable outcomes. So I think that needs a lot of attention from us if we as DFIs want to be able to finance this rapid transformation. We need to work very closely with policymakers. Another area, which is quite obvious because it's been a major area of investment for DFIs for more than a decade, but sustainable energy, renewables, is absolutely critical for the African continent to have a strong recovery, both because it is the type of investment that can be very helpful to create economic activity and job opportunities, during the recovery, but also because it really depends. It depends a lot on public and private finance to come together. So I think we have to see how we can be extremely strategic about these key sectors and get what we do as DFIs with our private co-financiers to really sync up also with what some of the multilateral public development banks and regional institutions are doing.
Thank you. Yeah, I think it's interesting they've introduced the topic of the green economy and of course climate finance, and coming into COP26, of course, it's very much on the agenda. One of the interesting things for the region in Africa, though, is around the green bond market, and of course we've seen a huge surge globally in the green bond market, but Africa largely has not participated. I think they've got something like 13 green bond issuances at the moment. Is there things that DFIs could be doing to support greater participation by the region in green finance?
Yes, I mean, of course, the long term, if we talk about billions to trillions, one way of putting it is that DFIs are in the business of using billions to catalyze the trillions. But we have to realize that it's not just the availability of assets that determines whether the trillions are unlocked and flow into the African continent. It's really also the overall risk profile of the economies and the investment opportunities that we present to them. So I do think as DFIs, we should get better over time at taking some of the assets that we have helped finance and getting them packaged in a way that they can be financed through green bond issues and other public securities. And I think we are reaching a critical scale in renewables, for instance, to get closer to being able to do that. But it's been difficult to do so far. But I suspect that this success of getting public bond issuance going or green bond issuance going will also depend on the risk perception of private institutions. And so I think DFIs cannot promise to do it just on our own. It has to be combined with the kinds of policy reforms that institutional investors are looking for.
Any particular wish lists for COP26 in terms of the outcome for developing countries?
Well, I do think we actually just as European DFIs and with strong leadership from CDC issued a number of commitments to align our financing with the Paris Agreement, go to net zero by 2050, and really align our activities with these priorities. And I very much hope that we can have a very strong alignment of wider alignment of public finance institutions to support that, to really drive more finance for renewables, but also for other sectors that can speed up the green transformation of the economy in Africa, with great outcomes also for energy access and so on coming alongside it.
Yeah, thank you. Yeah, I think there's obviously a path that you're outlining there towards both sustainable growth, but also significant growth in terms of poverty alleviation. So both critical goals.
Absolutely, yeah, it goes hand in hand.
Yeah, thank you, Søren. Chris, let me turn to you. You're slightly different from our other speakers in the sense that you're I would say the coalface, as we'd say in the UK, in terms of your work at the fund, and particularly your work in Nairobi and in capital markets. I was wondering if you'd like to speak a little bit about some of the achievements, of course, of your fund, but also some of the difficulties, and particularly in engaging investors, both domestically and internationally, in the issuances that your fund makes.
So thank you very much for having me. I hope I'm not too different, but perhaps Nick and Søren can comment on that. Look, the ALCB, which is one of the funds that we manage, we also manage two renewable energy funds. Was really established by the German government and then joined by the British government with the focus of saying, how do we get the domestic capital markets to work for the corporate sector? And this year has been a sort of a real test to see whether that thesis could survive in a sort of firestorm, as it were. There's definitely been some winners and losers, and it'd be wrong of me to say that we haven't been impacted by COVID. We have, but I'm delighted that actually the number of credits that have come into distress has been a very small part of our portfolio, in the area of 3 or 4%, which I think people would say, with a portfolio that is exclusively linked to African corporates, is pretty remarkable. That demonstrates two things in our mind. One, that a lot of Africa is less risky than the risk premiums and the ratings and the market would imply that it is. But also, there is a big difference between companies' ability and capacity to pay in local currency relative to foreign currency. And we've certainly seen an uptick in interest with the depreciations that we've seen across the continent, where people suddenly say, oh my goodness, dollar debt is not as cheap as potentially it looks. I'm old enough, sadly, to have lived through the Asia crisis. And I think back then in 96, 97, Asia just got an extraordinary shock, having lived for a decade before on cheap dollar debt, that currencies didn't stay stable forever. And you really saw a mindset shift in Asia. That was the beginning of the Asian economies developing their current account surpluses. And Africa, Dambisa would say, has had too strong currencies for too long. But I think this transition to properly pricing products, properly pricing power, etc., linked to local currency as opposed to foreign currency, and not persuading yourself that you're living on cheap power as long as the currency doesn't depreciate, will lead us to a much more sustainable space. Now, our fund is still tiny. I mean, we've invested over 200 million. We've got just over 130 million of bonds that we're invested in. Now, we co-finance and we've seen nearly 5 times our capital get redeployed. So there's been over $1 billion flowing into this, but we're at $1 billion, not at trillions. And so the key for us is, how do we continue to get scale? How do we get transactions to increase in scale? The remobilization of domestic pension funds is critically important. And there we have a little bit of a tension with the domestic governments, because as Vera alluded to, a lot of these governments are under fiscal pressure, and they would very much love those domestic savings to be redeployed into the sovereign bucket, as opposed to flowing into the private sector. So we see this sort of bridge that needs to happen. That's where the international capital is needed and definitely helps. But I'm going to sound like a broken record here. We feel that it's fund managers that should be taking the currency risk, managing that currency risk, as opposed to corporates that in truth are taking a sort of hedge fund type FX position, somewhat sometimes without really thinking about it, and you only then realize that, as Warren Buffett said, when the tide goes up.
Indeed, yes. Let me challenge you a little bit though, Chris, on your comments about the financial system, because I think it would be fair to say that African banking sector has been robust. I mean, we've certainly seen a contraction in lending, unsurprisingly, but we certainly are a long way from a systemic crisis. And some of the reforms, post 2008, particularly implementation of Basel III and the capital strengthening in the banking sector, I think it would be fair to say has paid off and been a success. But is it too soon to tell? You mentioned NPLs are relatively limited right now. but is that situation not going to worsen over the next 12, 24 months?
I mean, Judith, I'm going to say something a little bit controversial here, so feel free to mute me and kick me out of the. I mean, you know, the reason that you've seen sort of muted responses is that, you know, most people on the continent don't have access to any debt. And where we've seen challenges has been in some of the what one would say is the new lending banks. Or non-banking financial institutions who've been trying to break into this market. Now, I'm acutely sensitive, and this is the place where I beat up our guys the most, because I've seen what happened in India, and I think there's a very fine line between giving people the most amazing thing on the planet. And I remember when Barclays gave me my mortgage to buy my house, I felt like I'd won the lottery. I couldn't believe that someone would lend me lots of money, enable me to get keys to a house on the back of, you know, my job. So debt has an incredibly empowering ability, but it's equally incredibly destructive. And if people lend money without, you know, job security, et cetera, then you can really have problems. So for us, the key challenge is always trying to push these institutions to say, we want you to be active, we want you to be building your loan books, but it's got to be done responsibly. And that's just very, very hard. I mean, people should understand that getting that balance right is incredibly hard. It's incredibly hard here in the UK. You know, you see it with people getting into debt here in the UK. So picture it in less sophisticated markets. But to that degree, I feel that the shock of the crisis in Africa, the fact that it hasn't had a bigger impact to some degree, is not something we should be proud of. It's part of the fact that these markets are very undersupplied with capital. But they, you know, the crazy thing is, despite that, they're paying the highest rates for anybody in the world. So, you know, somewhere there's a disconnect there. Somewhere the, you know, where we do need to help bring rates down. A chunk of that, and I don't know who's on this call, so again, somebody may be upset, but is the sovereigns realizing that if you run a substantial fiscal deficit, then you will definitionally push up interest rates, which squeezes the private sector, and the whole chain continues. And we need the African governments to realize that, you know, if they can bring their fiscal more in balance, that will reduce interest rates, reduce real rates, and you'll get the catalysis of the private sector coming and responding. But when, you know, you've got desperate poverty in countries, et cetera, it's a very hard balance to fit for a finance minister to think, well, if I cut my spending, I'm actually going to increase my growth. And, you know, I know that CDC really pioneered this, but Søren will tell me that you know, the European DFIs do exactly the same thing. But at the end of the day, when we talk about countries being over indebted, I kind of actually think it's the wrong way around. Relative to the size of these economies, they're fundamentally under indebted. Their problem is that they are massively incapable, or they're raising incredibly low levels of taxation. And if your revenue side is pathetically small, then yeah, you are over indebted. And so the focus that institutions like CDC have had on, you know, what's happening to jobs, but what's happening to tax revenues is critically important. Get those revenues up, and Africa's under indebted, and the capital would flow in. But Nick may want to, or Søren may want to come in and bash me over the head if what I've just said is controversial.
I think it goes back really to Nick's point around, you know, macroeconomic management, and these fiscal issues are tough because, as you point out, there's also a significant problem with you know, tax mobilisation, particularly in informal economies, but also I would personally add that in economies that are fundamentally poor, and there isn't actually very much to tax in that regard, and therefore there's also only a limit to how far you can push tax collection as well. But the sheer difficulty of identifying a tax base is tough, and it's a kind of vicious circle for governments in the region in terms of their ability to raise debt that is sustainable. Maybe we can use that, because the ratios of taxes as opposed to GDP is probably the critical one for them. I'd also think there's quite a lot of evidence too about your comments about microfinance and the balance between responsible lending to households who essentially have very little income and no assets, and the ability to facilitate improved livelihoods is also an important one. Okay, Christopher, thanks very much. Maybe we can look at some of the questions that have come in. Guys, let me know if there's a question that you would like to take in particular. So you're welcome to talk to that. But maybe let me pick one off for you, which is a question around: is there an opportunity for DFIs to be more anti-cyclical in their responses? I would have said you've done a reasonable job in this crisis, but maybe you'd like to comment about whether you see that as your role, and if so, whether more could be done.
Well, it's absolutely our role when the crisis first hits, and as Nick said, it's risk off for all private investors. It's definitely the job of DFIs not to have a behavior where we try to recede or go away. And of course, I think as DFIs we were quite successful in being very present with clients to respond to their immediate needs, but also to continue to serve the pipelines that we have. So I think so far so good for this year. I think within the limited capacity that at least the European DFIs have had, I think we still don't have the final numbers, but I think it has looked quite good, and probably better than it did during the financial crisis in 2008 to 2009. Of course, the difficulty right now is that the uncertainty that exists about whether there's going to be a recovery in 2021 or there's going to be a continued crisis or even an escalating crisis. And frankly, I think, it's very difficult when we don't know more about how the trajectory of the pandemic will go in these countries to say exactly what the long-term response and trends will look like. But I think the DFIs and quite crucially also the shareholders, the governments that own the DFIs, have been extremely determined to be present and counter-cyclical. And Nick, I'm sure that goes for CDC as well.
Nick, would you like to make a comment in response to Søren?
Yeah, look, I completely agree with what Søren has said, and it is absolutely the job of the development finance community to fill the gap during a crisis like this. And I think you're right, Judith, that I think overall and certainly from what I understand was true during the financial crisis, I think the development finance community has stood up more quickly, more effectively, and to try to provide essential funding. So but again, as Søren says, in the long term, this is about the same development issues that existed before COVID. The same, we've still got 600 million people that don't have access to power in Africa. We still need to create 10 to 20 million new jobs a year just to sort of stay, stay where we are. Those problems are still exist. So going back to rebuilding and going back to what we did, I think, effectively before COVID, and the issues that we focused on before COVID is as important now as it was a year ago.
Yeah, thank you. Yeah, I think it was interesting actually. After the crisis in 2008, there was a lot of criticism of both the World Bank and the IMF about the speed with which they spent funds, and they did redesign a number of facilities. And I think Vera mentioned the IMF's rapid response facilities, but they did. I was on a call last week with some of the central bankers, and they do seem to have done better at getting money out quickly on this occasion. So again, it's a significant improvement in the architecture that we have.
Judith, can I just add to what Søren and Nick just said? What I've seen from our client base on the sort of advisory side is that this has been a really good crisis for the DFIs. And why I say that is that the companies that had DFI support have been able to get more capital. And that has been very clearly evidenced. And so therefore what you've seen is companies that had gone through the pain, and if anybody tells you it's not painful, they're lying, but have gone through the pain of getting their, aligning themselves and working out how to work with the DFIs. They were the ones who got access to liquidity. And what I think people have equally seen is it's incredibly hard for the DFIs, and maybe this COVID thing is once every 100 years. God, let's hope it is. But it's very hard to onboard a totally new client in a crisis. And so I think we are going to see, and I'm getting a lot of incoming phone calls from people saying, okay, I get it now. I'm willing to go through that pain and get on board with, with one or more DFIs, because they've seen that when the crisis comes, these guys are there and they will support their investees. Sure. And that, I think, is great to see, and evidence that that people really, now they're really seeing why they went through that pain.
Yeah, and of that sort of interaction between DFIs and the private sector and private finance, which is exactly the sort of synergy you would like to see.
Yeah,
Judith, if I could just comment, I think there is something we observe as DFIs that relates to what Edge is explaining, that we have probably seen, or we have seen, the client portfolios be more resilient in the face of the crisis than we first expected or first dared to expect at the beginning of the year. And we don't believe it just has to do with the clients that we have being on good relationship terms with DFIs, but we also believe that the way that DFIs now work with making the companies more resilient, having stronger environmental and social and governance standards that they work to, being more focused on the impact that they deliver in their community, we believe that this increases the resilience and the quality of the private enterprises that we work with. And it's a little bit similar to the discussion that you see in public financial markets, that highly ESG rated companies have been more resilient in the crisis overall than companies that have not had the same focus on working to high standards. And I think we are learning something about DFIs, about how to make sure that we can have clients that are as resilient in a crisis as possible.
Yeah. So another example of the sort of the hard work of laying solid foundations has paid off in terms of the ESG and that kind of due diligence and soundness in your business model.
Yeah. I think, Judith, if I just add to what Edge said, I think, because he's absolutely right. I mean, one of the almost unique characteristics about this crisis was, unlike sort of the 2008 crisis or previous financial crises, was it meant nobody could travel. And because you couldn't travel, you had to change your whole way of doing due diligence. And the first step for everybody, inevitably in those circumstances, to say, we can't look at new things. We can't start building new relationships when we can't go out and meet people. And so Edge is exactly right to say that the focus, therefore, was on ensuring that those organizations we had invested in and those intermediaries we had used before had access to funding. I think one of the things, though, that has happened over the last, encouragingly over the last 3 or 4 months, is that even though we still can't travel, I think the DFIs have become much more innovative about the way that they do remote due diligence. So we find now at CDC our pipeline, having sort of dipped precipitously in the immediate aftermath of the pandemic starting, has now rebuilt again, and we're able to do it by being much more innovative about the way that we actually interact with people remotely. So I think that's encouraging. And we should, I think, from the DFI community, should take some credit for the speed with which they found new ways to diligence.
Yeah, so that kind of innovative, quite nimble response, and new learning in the organisation has helped new ways of working. Yeah, that's great to hear. Guys, we've just got a few minutes left. Let me ask Nick one more question, which has come through, which I think is quite interesting. Then maybe I'll give you a minute or two each just to wrap up. Nick, the question through is, given the COVID context, will DFIs increase investments in social sectors such as health and education? I guess this really is a question around whether, you know, your sector priorities and sort of economic development in a sort of Buddhist context, whether that's infrastructure or various private sector aspects. Is it going to be a rebalancing back towards health and education, or do you see that as remaining maybe a lower priority going forward?
Look, I think that's a great question, but I think what we have to remember about health and education is in the vast majority of countries, they're considered public goods. They're considered to be something government should supply. The role of the DFIs is to fund private companies. And so, and funding, as we've seen firsthand at CDC, funding private companies in health and education is a controversial thing to do. So that because it means private schools, it means private hospitals, it means typically those institutions cater to the upper echelons of society rather than the poor end of society. So I think we've got to be realistic about that. On the other hand, I think there is increasing opportunity to invest. Again, we're coming back to this technology change. There's an increasing opportunity to invest in health tech and ed tech and ways of using technology to reach in a cheaper, more effective, more accessible way the poor ends of the community. So I think we've got to be that's where we need to focus our attention. I think in terms of investing in more private schools and more private hospitals, there's a case for that sometimes. But overall, it's not going to be the dominant part of a DFI's portfolio.
Yeah, I think also if we had a sort of took a macroeconomic view, of course, developing the private sector allows that tax mobilisation, which then allows governments to provide the public goods like health and education themselves. Let's just quickly wrap up. We've just got 1 minute each. Maybe just like to make some closing remarks. Chris, maybe you would like to speak first.
Look, I think the reality here is this has been a huge shock. I think that we are coming through it. I am actually an optimist. I think that we are going to need some more delevering, and you know, CDC is very good at this because they've had more of an equity focus historically than a debt focus. I think the European DFIs are going to have to become a little bit better on the equity side. We are excited by some of the initiatives coming out of Europe, such as the EDFS plus, which, you know, potentially, if targeted in the right direction, could lead to a lot more capital coming through. And the Americans are, you know, upping their game with the DFC as well. I think the venture space needs a bit more support. There's real shortage, and if Vera's, you know, coding, you know, girls are going to get the support they need. We need to get Africa to understand the venture space. And the other end of the spectrum, where still there is a market failure, is around the flow of capital into what I would call frontier emerging markets, which is Africa's a big part of, as opposed to the EM markets. So, you know, the market cap of the global EM space is something around $7.5 trillion. The market cap of the frontier market, which includes a whole bunch of markets which, you know, are not really ODI, is you know, is sort of $100 billion. So you can just see the scale that, you know, there are great companies in some of those in those countries, but we have to get, but people just don't focus on them. They don't know they're there. There's no research on them. So I would say we need a barbell approach, more institutional money flowing into the public side, but equally a little bit more going on the early stage side as well.
Oh, okay, thank you very much, Chris. Søren, would you like to make some closing remarks? I think you're on mute. Okay.
Thanks very much, Judith. So I mean, so it's evident that DFIs need to continue to push to be present and to work with companies through the crisis, but also that we need to be prepared for the recovery that comes after, and that's going to require significant amounts of risk capital, so the kinds of equity investment that Edge talked about, but also willingness to support developers and others that are going to supply the pipeline of projects that will be financed in the recovery. And I think we're going to have to be more bold as development finance institutions to be strategically directed. I think that's clearly the case for sustainable finance and inclusive finance or financial services, which are both powered, as we talked about earlier, strongly by technological developments and changes in pricing and available technology. These are going to be probably together with some of the agri sector and other sectors that will benefit from freer trade on the African continent. These are going to be some of the sectors of very strong opportunity, both for investment but also for impact through the recovery from the crisis. And we're going to have to be very strategic about combining our financing activities and the policy reforms that can supercharge this in the recovery.
Thank you very much. And Nick, maybe you'd like to make some final remarks.
Yeah, I agree with both Edge and Søren. Like Edge's sort of description of a barbell approach, I think that's a very good way of thinking about it as we go forward. I think, as we said earlier, I think DFIs have had a relatively good crisis so far. But as we go forward, it's all about rebuilding and solving those development issues that largely existed before COVID. And it is a barbell. On the one hand, we've got to be more active on the smaller end. We've got to be more of a catalyst in helping new technology develop and address some of those key development issues. But then on the other end, from an infrastructure perspective, as I said earlier, we still got 650 million people that don't have access to power. Without power, you can't have schools, you can't have hospitals, you can't have factories, you can't have large scale employment. So our role in that area is still as important as it ever was before.
Okay, thank you. Oh, thank you very much, Nick. So I think we'll wrap up as we're just over time. Obviously, we'd like to thank all of our panelists for coming today and for your very interesting comments. Just a quick comment on some of the themes. I mean, there seems to be some pretty good feedback that DFIs and IFIs, as Nick just said, had a good crisis, and certainly the lessons of 2008 have been learnt, and those were reflected in the ability to respond and support economic growth and social goals in the region over the last year. Also, though, continuing focusing some on the old themes, particularly macroeconomic fundamentals, ESG. We mentioned about laying down the foundations, that allow you to be robust in this type of crisis situation, and also recover more rapidly. And probably most interestingly for the region, of course, the new innovations, and particularly in digitalization within the economy, both finance but also in the private sector, which of course is very much talked about and is probably one of the most important themes for accelerating economic growth and reaching the poorest in the region going forward. So thank you very much. Thank you very much to our audience today. It was great that you could join us. Also, just to mention that the ODI will be having another event. The next one will be on healthcare. If you were invited to this one, you will be CC'd on the invitation for that. And meanwhile, thanks again very much to all our panelists. It's been great to talk, and we really appreciate your input.